Because your own enemy is yourself. So we can give you all of the tools. I can teach you everything. We can have all of the best people in the world teaching you, and you will screw it up because of the voices in your head. And you need to. I've been writing about this in Real Vision Pro Macro for months, saying, okay, this is where we're going. These things take time to play out. And these things mean, okay, the markets need to price in a collapsing growth. And the inflation story is going to change into a growth story. And it's going to pivot what markets do. So things like oil, which have been leaders, will not do as well. Commodities will get hit because of demand destruction. And we'll eventually see bonds rolling over, and probably more so oil. And as we see that trigger, we will see the kind of growthier end of the market starting to outperform. But basically, it's now become clear from the forward-looking data, the Philly Fed and everything else is just showing it. But if you start to look at the really forward data, like the new orders component of all the regional Fed surveys, they're pricing things like ISM at 35. You know, these are shocking declines, which I've been trying to tell people about. Is economic growth over the next 3 months is going to shock people to the downside. And it's going to change everybody's narrative from, okay, we're in this sticky inflation environment, the supply constraints, to, oh my God, we've broken the economy. The dollar is already pricing ISM around 45, so it's already pricing a full recession, but I think it's going to be bigger than that. So I think the rate of change in the dollar goes further. So that's still a wrecking ball, still to keep playing out over time. I think there's still washouts to come from the energy sector and others. Doesn't mean we go all the way back to the pre-COVID levels where many of the markets have got to, but we're going to retrace a lot more of that. My base case is that oil comes down somewhere between $80 and $60, to $80 and $60. The equity markets are somewhat more complicated because they're already pricing in, the S&P is pricing in ISM around 45, so there's a bit more room. The NASDAQ is around about 40, so it's pretty much priced in what I think is coming. My forward-looking indicators, which I'll show in a minute, will suggest that the bottom of the economic trough is like March next year. But I think stocks bottom first. So in 2018, they bottomed a year before the economy. In 1974, these are the parallels I've been using. It bottomed 3 months before. So it's somewhere between that. So I think they bottom in the next few months, or they have bottomed. But it's not clear to me. But I think the base is in, and I've been saying that for a while now, because crypto is a very forward-looking asset, and it will look further ahead than anybody else, and it's sniffing out the change in bond yields. So that brings me on to the most important part, which is bond yields. Bond yields are now rolling over. As I've been forecasting, they're about to break a head and shoulders top pattern. So if it breaks that, then we should start to go down below 2%. I think somewhere around 175. So that's not what the market expects. But if you think of what that does to growthy assets, it's taking down the future discount rate. And if that means that inflation is coming lower, then you're taking some of the inflation expectations out. So things like what I refer to as the exponential age stocks, the further out the growth curve, things like Scottish Mutual Trust in the UK, which I've just interviewed on Real Vision. They're amazing, some of the best tech investors in the world. They're going to be coming on, but also, whether it's the semiconductors, whether it's ARC, whether it's robotics, and all of this that I've got a whole basket of, these should start to stabilize and do okay. And we're starting to see that now, but it's still early days because they will be slightly behind crypto in terms of forward looking. So we're at this massive shift where inflation goes, growth goes, and bond yields start to fall. So Brian, if you can show the chart of the GMI kind of financial indicator. So what this shows is that financial conditions, this is the rate of change of the dollar, rate of change of yields, and rate of change of commodities, are showing a massive decline in growth. And it leads ISM by 9 months, which tells us that in 9 months' time, ISM will have bottomed because it's already ticking up. So when we map assets across them, and if anybody goes to my Twitter feed today, you'll see that all assets correlate to ISM except crypto, which I'll come on to. So they all correlate, all macro, it's all about the business cycle. If you don't understand that, then it's really difficult to navigate yourself around this world because you're flying blind. But when you look at it, this chart, what it's saying is bonds are the most mispriced of all assets. They're actually pricing the ISM at 65, which is not where it is today. It's in the mid 50s, or mid to low 50s. Then it's high yield spreads, then it's small caps, then it's cyclicals. They're all kind of roughly in line with ISM, so these could move lower. S&P 500, as I said, is leading the ISM. It's at 45. The NASDAQ is getting down to 40. And that GMI exponential age basket is already pricing ISM at 35. Finally, crypto. So if you bring up the final chart, Brian, is crypto isn't driven by the business cycle, but it's driven by global liquidity. So this is the global M2 deviation from trend. So it's the rate of change of M2 and how far it is away from trend. And it's about 1.5 standard deviations away from trend, and it's turning higher. That time it ever happens, both at the top and the bottom, leads to the turn in the crypto markets because liquidity drives crypto. Remember, this is not a cyclical asset, so it doesn't go back to where it was like oil and commodities. It's a network adoption model that goes up and to the right over time with these big volatile bands. Now, a lot of people had the narrative that this was driven by the halving. Now, maybe the halving, which is a reduction of supply every 4 years in Bitcoin, is a factor because it's correlated with liquidity. So what you're doing, you put more liquidity into the markets, it leads to more people able to allocate capital into a low supply environment, which is the halving. You don't need the halving as a necessary precursor. Ethereum's about to have a triple halving event. I'm going to do a whole update over the weekend. I'm going to film for Real Vision members about all of this. It is macro. It's macroeconomic investing. So what you're doing is using the global economy as a forecast for asset prices. And you're looking for dislocations, mispricings, or opportunities based on that. So normally how we look about this is the business cycle. The business cycle is the ups and downs of GDP that economists never forecast because they use linear models. But once you understand that the economy is cyclical, you understand, okay, it's forecastable because usually when it rolls over from a peak, it goes to a trough, which is a recession. After recession, you go to recovery. That cycle, you can show a 3-year-old kid and they go, oh yeah, well, the economy goes up and down. You ask an economist at the Fed and they say it's linear, as do all economists. It's crazy. It's crazy that people don't model this, which is why macro-based investors tend to use the business cycle because it gives us an edge. And why all economists tend to be very wrong at turning points and these acceleration points, but tend to be right over a longer term time horizon when you look at averages. People just don't understand. They know it's important, but they don't even know how to think about all of this. Not just what is macro, but how to invest, how to think about building portfolios, how to think about risk. What is technical analysis? What the hell is Raoul talking about when he talks about DMARC indicators? What do those numbers mean? What does any of this mean? Right, I get it's important. I know it's my future. It's my financial future. My vision of myself is based on how well I can invest the capital that I've got or protect it. Other people go online to find courses, and there's either a bunch of shitty YouTube courses by people who've never really been in markets, or they're really expensive, and again, generally by not the highest quality people. Why? Because the highest quality people don't need the money to charge for a course. So what you get is a self-selective bias. And I've been concerned about this since I started Real Vision. It's like, if we believe in our mission to democratize the very best financial information, education is part of it. We talk about learning all the time, but we can't just leave people to try and figure it out. Now, we do already create learning content on the platform, explainers and all sorts. Even for the pro macro, we have explainers because people are like, I don't get this yet. And that's fine. And that's okay. There's nothing wrong with not understanding. But it's wrong if I don't help or we don't help. Things I was taught was to take notes when you make trades of why you did the trade, what your expectations were. what your risk tolerance was, what your time horizon was. Because your internal voices, because your own enemy is yourself. So we can give you all of the tools. I can teach you everything. We can have all of the best people in the world teaching you, and you will screw it up because of the voices in your head. And you need to learn how to tame those voices. Time horizon, plus the volatility of the asset, will set your position size, which is your risk. One of the most incredible things I ever saw was when I asked Kyle Bass to interview John Burbank, so two really famous hedge fund managers. First question, Kyle, he just couldn't bleat it out fast enough, was, John, how do you size your positions? These things are hard questions. There's no simple answer. I mean, so in crypto, I don't think it is. I think it's the foundational rally that starts it all off. In equities, I'm not sure. My hunch is, because of that year-on-year rate of change that I showed you, that it's not quite fully pricing in where we should be going. We might have another leg lower, or it might squash along the bottom, and because of the year-on-year comparisons versus last year, in 2 or 3 months' time, it kind of maps that. So I don't know is the answer, and I wish I had a better answer, but I don't.